Joining us now is James Demmert, CIO at Main Street Research. James, good to have you with us. Let me get started with the optimism that we're seeing when it comes to risk assets with that incredible rally that we've seen in the United States. Do we still have room to gain from here, and what are the implications for Asia?
Yeah, it's an impressive rally, Sherry. Who would have thought, 4 weeks ago we were down 19% and now we're sort of back to new highs. And we think this has much more room to run. I think our target for the S&P 500 is 6,800, which is one of the highest on the street. And we think that's backed by, in the U.S. story, sort of a not too fast, not too slow economy, with some headwinds with policy in the U.S. being restrictive on both the fiscal and the monetary side. But, stocks like that kind of environment, particularly the tech stocks that a lot of them are in the U.S. So we think that the U.S. market can go higher from here. But we are big fans of investing outside the U.S. We're a global manager. So we find the Asia markets even more attractive.
Before I get to Asia, I do want to ask you a little bit more about the United States, because you said markets like this environment, especially if we're talking about more potential rate cuts to come from the Federal Reserve. And take a listen to what President Trump had to say.
And if we had a person over at the Fed that would lower interest rates a little bit, that would be helpful too. It's hard to believe this is on top of, we have to fight this guy. He's not doing the job. Each point that he keeps it up is the equivalent of $300 billion. $300 billion. So if he loaded two, it would save $600 billion.
And we're already seeing a steepening yield curve. I mean, how much more does this muddle the picture for markets when really expectations of the monetary path is really what leads to changes in levels? Do you invest at this point or do you get out?
Well, I think investors are concerned here. Markets back to the old high. Maybe it's going to roll over. And I think investors want to make sure they look forward and they look at earnings. And, our view is the Fed probably will cut in the second half of this year, but it won't be because of what Trump is asking for. It'll be because the economy has weakened more than expected. We're seeing it in the soft data. We would expect, this economy can't withstand the headwinds of tariffs and the fiscal restraint that's going on in the U.S. So the Fed's going to have to come at some point, and that's what we call the Fed put. So you got stocks. We think earnings in the last couple of quarters in the U.S. have been way better than expected. We think it's going to continue in this quarter coming up, in the last quarter. And I think when the Fed has to maybe cut rates because the labor market's getting a little worse, maybe sometime in the third or fourth quarter, that's going to push us that one more rally up. So, these kind of slower, softer economic climates, stocks can do quite well, and particularly when you've got the Fed ready to go if they need to. And again, I think they will because of the economy, not because of what Donald Trump has to say.
Does that involve Asian risk assets as well?
Well, that's the interesting thing, Sherry. The last, decade, U.S. exceptionalism, most investors, even foreign investors, are way overweighted in U.S. equities. And so that's, the U.S. equities sort of are the dog that wags the tail for the rest of the world. Our view is that's going to change. It already is changing. Foreign markets have done better than the U.S. so far. As far as we're concerned, this is a significant new world order for fiscal and monetary policy. Both are restrictive now in the U.S., which is a big change from the last 10 years. And it's the opposite outside the U.S., particularly in China, where they're being very stimulative with fiscal and monetary policy, and we're taking everything to it. That is really good for the economies and good for the stocks.
Does that mean you get into China now, or do you wait until you can see more concrete proof that they're actually really putting that capital in?
I think a mistake investors will make is just not doing anything, and waiting. If you look at the history of any economy that's put so much effort into, stimulating growth both fiscally and monetarily, like China has, you want to be careful not to wait till the whites of its eyes are seen. By then, stocks will have gone up way too much. So if I had zero stocks outside the U.S., which I do not recommend, we're about 35% outside the U.S. I would say, hey, my allocation to, let's say, China, maybe it's supposed to be 10 or 15, 20%. I would do a third of it now. I would not be waiting. And then, into volatility, I would be adding to that over the next few quarters.
How closely are you following the U.S.-China trade negotiations? So apparently we have a trade deal that has been signed already, but at the same time, of course, these restrictions against Chinese tech continue.
They do. And I think that's one of the mistakes I think we make as investors is taking that headline and sort of asking ourselves, geez, well, I'm so uncertain I'm not going to do anything. And I would suggest that investors not do that and look through to the tariffs and look for companies that can establish and have been able to establish very good profit margins and earnings. And there's a lot of them in China. There's a lot of them in Japan, throughout Europe. And recognizing that if the tariffs do come a little worse than expected, these companies will survive. But what's interesting, Sherry, and you've probably seen this, markets, with these negotiations supposed to be happening in the next few weeks, markets have seemed to be very resilient going towards that. And I think that's the market discounting that things are not going to be as bad as people had expected. So being an investor is important, but definitely make sure you invest in companies with high profit margins and good balance sheets.
Are you seeing that in Japan? You seem to be bullish in this market.
Yeah, we like the story in Japan as well. Not quite the monetary stimulus that you see in China because their economy is not in that kind of dire straits or was. But you've got companies, good examples, Hitachi, industrial maker of all kinds of equipment. They're part of it, which is part of AI, supporting AI, which is a global sort of early stage of that resolution. And then, of course, you've got Sony, which is another one of our favorite picks. Big liquid names, strong balance sheets, high profit margins, and we think those are great positions. Japan, China, Europe been pretty much neglected for the last, 10 years. In our view, that neglect has allowed PE ratios to be super attractive. They're very cheap, and we think money will be flowing not just this year, which it already has, but multi-year, a return to foreign markets.
And investors are taking notice, right? Right now, Japan's Nikkei rising to 40,000 for the first time since January. So we are seeing more movement and dynamism in this economy and the investing landscape as well. But when it comes to fiscal spending, you talked a little bit about that earlier, but we are expecting the upper house elections here. Everybody wants to spend their way into office at this point, including Europe, where you mentioned the opportunities are. How risky is the situation when you're looking also at the volatility in the bond space?
Well, it appears to us that the fiscal stimulus that's been turned on, particularly as you mentioned in Europe, has got legs. We think that's going to be multi-year, and that's really because the U.S. has just withdrawn that financial support. So they've had to turn that on. They've committed to turning it on for multi-years. What that does is it really injects tremendous amount of growth into the economy. And if anybody's wondering about that, just look at what the U.S. has been doing in the last 10 or 15 years. It really is great for the economy. It's really good for stocks. Now, that can create upward pressure, that kind of growth on rates, but that's normal. But I think investors should be careful about that. Rates rising, you want to make sure that you've got bonds that are individual bonds, high quality is the best way to handle that. Not too long in duration.
Jim Demmert, really good to have you with us, CIO at Main Street Research, of course, as we look ahead to the market trading session today.